Midweek in the Champions League, I must say that the global markets have not really disappointed. In fact, the mood or the sentiment in the global market seems to be that of risk on, with some of the Asian markets also rallying to their 2007 high. So is the global setup really in a better shape, or does it only mean that the liquidity bubble is a lot more closer now?
So we've been talking about this liquidity bubble for a long time now, and it's still not been burst by anything. You know, we saw some comments coming out from the Fed yesterday, which were kind of a little bit more dovish. Yes, they're going to increase rates, but there's some of them are saying yes, some of them are saying no. And there's going to be a complete change within the Federal Reserve next year in terms of people. So everyone's thinking it's going to be more dovish than hawkish going forward. And I think that's just helped the markets kind of ease from thinking about what it means for higher interest rates, what it means for the tightening of the balance sheet or the reduction of the balance sheet. What I still think it means is that bond yields have to go higher in the US, and it's going to mean a stronger dollar as well. And there could be some turmoil around the bond markets because of that. So we're still concerned about that. But you know, our concerns are not being factored in by markets, which are continuing to move higher. So I think the more we see this, that the bubble just gets a little bit bigger, right? And that's my concern.
So Andrew, you know, Moody's recent upgrade of India's sovereign ratings, skeptics say that it's more of a hope upgrade than anything else. What is your reading?
So obviously they have their own criteria to do that, and I think it's been in the works for some time. And listen, India's, you know, actually done a very good job over the last 2 to 3 years. The fiscal deficit's been, you know, kind of reined in, and the reforms that Prime Minister Modi's done, you know, we all like. We might not like them very short term, but we think they're all very good longer term. And I think that's where they're looking. I mean, if I look 2 to 3 years out, I'm thinking that the economy will continue to now move ahead, unless there's any, you know, other major reform just to slow us down in the short term. And I think therefore, if you take that with global growth, which we're all expecting, then, you know, I think Moody's is probably correct in their assessment of where India is right now and where they'll probably be in the future. What could go wrong in terms of that rating, obviously, is if the oil price kind of, you know, shot up towards, say, the $100, or which would then put pressure on the fiscal deficit and inflation, and that could slow the economy. So those are the kind of things which maybe that, you know, no one's really expecting, and so it's okay. I think it's a good boost for sentiment, and actually, good news is now companies can go offshore and get lower. You know, lower levels of interest on the debt.
In fact, I just wanted to touch base upon the fiscal deficit issue that you brought up. Just want to understand, are you factoring in a fiscal slippage in this year, or do you think with the Moody's upgrade coming in, the government's hands are tied now?
No, I think there'll be some slippage. And you know, listen, if it's anywhere up to no more than 0.5%, I think that's okay. We're an emerging economy, and you know, still growing very quickly. So I don't see that we should worry so much. You know, as long as growth is coming through, a bit of slippage here. You know, corporate capex is really not taking off, so you've got to give it a helping hand. But what are we asking for in other developed markets is actually the same thing, right? We're asking governments to start spending more on their fiscal spending, to kickstart the economy a little bit more, to get the animal spirits and going. But obviously those countries themselves have a lot of debt, so you know, we can't say it's just not very good for India.
So, you know, coming down to foreign ownership, as you may have noticed, where we are looking at some amount of tapering, at least when it comes to fund flows in India over the last couple of months. Of course, now you have this upgrade when it comes to Moody's. A lot of them are expecting some upgrade of the other from S&P for that matter. Keeping valuations in mind, what does this mean then? How does this play out when it comes to valuations? High valuations on one side and expectations of upgrades on the other side.
Okay, so the Moody's upgrade is probably more helpful for the bond markets. In terms of flows to the bond markets, rather than the equity markets. But you know, if we take a view that global growth, which is what we're thinking, will take off, then India's not a warrant on global growth because we're a domestic economy.
Right.
So foreign investors, when they're looking at their allocation, are going to think, okay, South Korea, Brazil, Russia, which are all warrants on worldwide growth and cheaper valuations than India. And that's where they're expecting to get better returns going forward. Because you had a great return from India anyway, being a domestic-driven economy. And where valuations are, you can see better value elsewhere. That's why you've been seeing more shift towards other markets than India.
Right. Andrew, we're also looking at Gujarat elections, which are around the corner. It's I mean, it's not something that will majorly impact markets, but that said, we are also looking at the union budget, which is going to be in a little over 2 months. The question then comes down to what the government can do. What are your expectations of the government, and what impact can that have on equity markets then?
So, the budget, I think if we can continue in the same direction that we've been going for the last few years, I think we'll all be happy at that. I mean, listen, every industry will want to get some benefit and so forth, but it's very difficult to say which one should. I think as long as we get the same message, with, whilst there might be slippage in the fiscal deficit, but the finance ministers, concentrating on keeping that reined in. As long as we can see where the growth is coming from, where they're going to be spending the money, I think no one's really going to be too worried. Okay. So the elections and the budget are usually a 1 to 2 days sentiment impact. Right. You have a run up before, and then we have some profit taking, or vice versa. And that's how I see this one as well. Okay.
Right.
Yeah. I also wanted to talk about a recent report that I came across, Goldman Sachs actually, where they have said that they're expecting the RBI to hike interest rates, by about 75 basis points by 2019. Just wanted your, opinion on where the interest rate cycle in India stands. Has it bottomed out? Because if it does, that could have implications also for the investment-related demand then.
So, I think, without having seen that report, but see if global growth is happening, then we're going to see interest rates rise elsewhere in the world, which again would mean either a strong dollar, a strong euro, or a strong yen against the rupee. So I think to my mind, the RBI missed their opportunity the last time around. They should have reduced rates because we're going to go into interest rate rising regime going forward. And if oil prices continue to head upwards, then that's going to be inflationary. And therefore, I don't see that they have the opportunity to reduce rates. So probably more likely they'll have to raise them at some point in 2018. So that's a bit of a disappointment. But that said, I think a lot of companies, I'm not saying all companies, a lot of companies have tried to deleverage their balance sheet over the last few years. So I don't think we're as bad in position as we are for higher interest rates going forward. But obviously that would have a negative impact both on bond yields, because we'll see them head towards 7.25 very quickly. And that would obviously not be good for those companies still heavily indebted. And the banking system as well, which has been enjoying lower yields, which has helped shore up their balance sheets a little bit more than they would have expected.
Andrew, how would you sum up the earnings for the quarter gone by? I mean, how has the earnings delivery been as compared to what you were estimating? And of course, I also want to understand that while markets have factored in about 20% plus sort of a corporate earnings growth number, what is more realistic according to you? What number is more realistic?
So we've never had 20% for this year. I mean, we never had 20% for the last 4 years either. So we've been always factoring 0 to 10%. So I think it's going to fall around 5 to 7% for this year. The thing that might just kind of push it up a little bit more was, this quarter and next is the kind of after effects of demonetization. So that might be a lower base. For those 2 quarters to push earnings a little bit higher than maybe in thinking. But 18-19 we're looking at anywhere between 10 to 15% earnings growth, then accelerating there. So over the next 3 years, if we take 2018 as a start, we think earnings could grow anywhere cumulatively by anywhere between 30 to 50%.
Of course, we also have the OPEC meeting on 30th November, where the markets are expecting the group to extend the production cut into 2018 as well. First of all, just want to understand, do you believe that oil prices can sustain at the $65 kind of levels? Because that would, of course, like you said, have multiple implications for India. You'll have implications for on the fiscal side. It could, percolate into higher inflation risk, and of course it could also have an effect on corporate earnings growth because it would pass through as higher input costs. So just wanted your view on oil and how you're looking at it. So
in April we kind of felt that the oil price then, when it was around 40, would head towards 60, which it has done. So we had to rethink about the reasons behind that and what we expect going forward. So our reasons behind it was that the global economy will start to pick up, and actually the supply demand is virtually kind of matching at the moment. So therefore demand will probably actually now start to outstrip again. So we'll see the oil price. So we think it's going to head towards 70 in the short term.
Okay.
And when we think about India, obviously you've mentioned the points of pain that will bring. If you take 2 years ago or 3 years ago, we benefited from a lower oil price, and the reverse has to happen. Okay. So, obviously it's going to, impact quite a number of sectors, but also there's other sectors which will be beneficiaries of the growth as well. So it's just realigning your portfolio to those. But I would have thought, therefore, you won't see the markets, if the oil price does hit 70, kind of moving away too quickly on fundamentals. Liquidity can do anything, but on fundamentals we shouldn't really see a big increase in terms of the expectations for earnings growth because of that margin pressure that you talked about.
Okay, so based on your outlook on oil, then how would you play OMCs as against something like a Reliance Industries, or for that matter ONGC then?
So obviously ONGC's got to be a beneficiary, and Reliance too. My problem, as always, OMCs, is that it's kind of the government control over that is always my concern. Yes. If you think about 3-4 weeks ago, there was a big hoo-ha about prices going up and so forth and so on. So there's always a bit of control which I don't like. Or I can't kind of think about in terms of how that would, when would that happen, and what would they do about it. I suppose, from the fiscal deficit viewpoint, the government's got to think about, they've benefited from a lower oil price, which has helped them. What would happen with a higher oil price? So again, they've got to play the two sides. So I don't see OMCs being the best way to play a higher oil price. And also I think, at some stage, Reliance in their AGM had talked about the investment BP had made, to go into the retailing, and maybe they're going to be a little bit more disruptive going forward in that sector. So there could be a bit of pressure in the OMCs going forward.
All right, so then Andrew, if you take the entire market together, what do you not like? What would you go ahead and sell, or what would you go short on, for that matter? Yeah.
So obviously in an interest rate rising regime, PSU banks come to the fore straight away. But we've become, after the government talked about or the finance ministry talked about the recapitalisation, we're kind of sitting on our hands a bit because we got we want to see what the full package is first. What we do know is that the recapitalisation won't be enough, so they'll have to raise more money through QIPs and so forth. And then we can decide where we're thinking about interest rates. So that would be one sector which we still would be bearish on. But obviously at the moment they have a tailwind in terms of the recapitalisation. Still not sure I like the fundamentals of IT and pharma. But tactically we think the rupee will get weaker. Therefore it's a good safety bet in terms of those two sectors. We're sticking away still from the kind of areas like metals in the short term. It's had a good run. We still like the metal sector, but we're not chasing it at the moment. So the problem is that it's not as though we think everything's very bad in certain industries. It's the valuations which are are more scary.
Right.
So it's more on the valuations rather than saying there's a sector which is going to go down. I mean, the power sector, for example, is a clear sector which I can't see any kind of resolution at the moment.
Right.
But obviously what people are saying is that, now that the government's done something with the PSU banks, they'll now look at power as the next stage.
All right. Andrew, we often get a stock markets 101 question from a lot of our viewers who are relatively new investors in Indian equities. So, a lot of them ask us that if markets are so high and if I want to, say, let go of my investment partially or completely, what are those factors that I will use to decide that, okay, I'm going to let go of some portion of this investment? So when it comes to security in general, what would you look at then?
So it really depends on your risk appetite. So it's if you like a lot of high risk and you can sleep at night, then that's great.
Right.
But I think generally I would say that if you've got some good gains and you are worried about the markets or some sell-off,
right.
Taking 10% as prices rise, over a period of time. So if you put in a capital of 100 and it's now become 200. What's wrong with just taking 100 back out?
Right.
You're still invested in the same company with the same capital.
Yeah.
But now you have another 100 rupees, which maybe you want to do something else with if markets were to correct, or find another opportunity. See, when a share price doubles, is it going to double again? Or is there another stock which you could look at, which you feel might do the same?
Right.
So so diversify a little bit from your portfolio, where you have good gains. Yeah.
Andrew, you're talking about IT and pharma. Those were supposed to be the two traditionally defensive, defensives where anybody would take shelter, when a market correction comes or is expected. So do you still see those as defenses right now, given the kind of growth concerns and structural changes that we have seen in these two industries? And if no, then where would you hide if that correction that you're really expecting does really come through?
So that's why we've tactically moved away from being so negative towards the sector. Say fundamentally nothing's really changed. But if we think that the rupee is going to, kind of weaken and interest rates are going higher and global markets could fall because of that, then it will be the place to hide. So there'll be, IT, pharma, and FMCG. Okay. FMCG, we love the fundamentals, so we're very happy and invested in FMCG. Okay. As we spoke, the last time I was on. So, it's just that the IT and pharma, there's still some more pain to come. Whereas the telecom sector is probably out of their pain, and there's going to be, periods where it will come back. I think IT is another 1.5 years away from coming through, and pharma's just started, unfortunately.
Right. Well, of course, you mentioned FMCG, which was naturally going to be my next question. And I suspect you would say that high valuations will not matter as much because they've always been trading at a relative premium to the rest of the market. But the volume trends, which are still just largely in line with consensus, not beating them, that doesn't concern you?
No, because I think over the next 2 to 3 years you'll see volumes really start to pick up.
Right.
But also, more importantly, you're going to get margins improving as well.
Right.
And that's going to be that will fall all the way through to the bottom line.
Right.
I think the other thing as well, as I've mentioned previously, but if you take some of the multinational FMCG companies here, which is HUL and Nestle, both of them have activist shareholders over their shoulders globally. So they will try and get their overall operations moving a lot quicker, which will obviously have a benefit to Indian operations too. So you're going to get not just the growth in India, but the overlay of the global group trying to get better margins and higher sales because they've got activist shareholders looking at them.
Right.
I just want to go back to the discussion that we were having on state-owned banks that you were talking about. Have you changed your stance on those banks, or you still remain negative?
No, we moved to neutral, because of the change in terms of recapitalization. So, we've been saying that they have to be recapitalized. Now they've done it, so that's very much a positive. Now we just need the final details to see what needs to be done. I'm not of the view that merging all of these small banks is going to change anything. So I think there's going to be consolidation within the industry, within the banking industry, but we have to see which players are playing with each other first.
Right. No, so have you changed your or tweaked your allocation as far as these public sector banks are concerned after recapitalization? And again, even if somebody is looking at the space, you know, how would you decide what to pick? Is it that a person should look at the turnaround story, somebody that could really benefit from the capital that's coming in, or probable acquisition candidates, or how would you look at this space?
So I said we're going to sit on our hands a little bit because we don't know exactly how it's all going to play out in terms of the recapitalization. There are turnaround banks, you're right. There are kind of acquisition plays, you're right. But I'm not sure some of the acquisition plays that I've heard about, 2 and 2 equal 4, they probably equal 3. Right? You know, has the management changed, you know, to take forward banks without making some of the same mistakes, or will there be a different way of managing the banks? Will the finance ministry look at certain criteria that they would want to see for recapitalising the banks? So all of this, I think, until we see that finer detail, we're just holding back from you know, saying which ones we want to take a view on. So, you know, in our long short fund, we were, as you know, we've always had a negative view. So we cut those shorts, and now we're just sitting and waiting.
All right.
Okay.
Yeah.
Any, you know, anything that you like in the infrastructure space? It's huge, but anything that you like there from a long-term perspective, of course.
So, you know, obviously looking at the capital goods sector is a way of playing that. We've always liked from the beginning of the year affordable housing, so that's another area which we like and continue to like. But you know, it's all about execution for a lot of these capital goods players. So if you looked at the results of L&T versus BHEL, there's a big contrast. Right. So I'm not convinced I need to be fully in the infrastructure sector, but there's certain segments or certain companies which I feel, you know, are doing the right things. Okay. Affordable housing, I think, is just a great growth story for the next 3 to 5 years anyway. So we're very happy there. With capital goods players, I think, whilst we're seeing a lot of money being thrown in by the government, the execution is still not there for a lot of those companies.
Right. Well, you know, Andrew, the last time we spoke, you had shown a little bit of interest in Bitcoin. Back then, it was at much lower levels than it is right now. There is the question of whether or not it should be considered as a currency or a store of value. As a currency, it has its limitations because for now, as of now, the way things stand, the transaction costs are very high. As a store of value or as something that can be exchanged, again, because of you know, the block size, it poses some limitations in terms of number of transactions that can take place at a certain point in time. You know, considering all these limitations, how would you view Bitcoin now that all of us know a little more about Bitcoin then?
Yeah. Well, I probably only still know a little bit more than I did last time. You know, the way I'm thinking about it now is that all of the things that you said are the hurdles are all the things that I think people are working on to improve. And there's talk about doing ETFs in there. I think, was it Norway said you can exchange Bitcoins and, to pay for things. So it's happening. It's maybe not happening at the scale that, you know, should justify the price of buying one. But, you know, listen, I'm just going to sit there with my little Bitcoin and see what comes out. Right. Yeah. But, you know, for everyone who's saying it's a bubble and so forth, it hasn't been that way yet. Right. And I said, I think for people like myself, it's really as, you know, to help me understand something going forward. Because I think it's going to be a lot, the youth who are going to accept this a lot more than probably I would going forward. But they will, because it's something that they grow up with or they know, and so it's easy for them to adjust to it. Okay,
but then for those who draw parallels to Bitcoin with, say, something like the tulip mania, or for that matter, many other bubbles that we've seen in the past. What is the difference then, and why would you then suggest that this may not be a bubble just yet?
I know. I mean, you're going back to the 1800s, right? For the tulip thing. So I don't even know.
Or for that matter, the dot-com boom very recently as well, in the 2000s.
Dot-com boom was 2000s, but I think a lot of those companies have grown out from those, risen from the ashes from there.
Right.
So some didn't, some did. Right. So it's not as though we've gone away from those industries.
Right.
Since then. I'm not saying that it could not be, but if it continues to rise, and there could be technical reasons why it could fall, but I think I got to think about how this is displacing. So it's like a fintech to me. It's trying to challenge something of how we kind of think, and obviously gold is one area that it's being compared with as a new means of payment. I think increasingly, as you see more and more institutions say we're ready to accept it, the more acceptance it will get. And I think that's where we are. If all of this was with no acceptance, then I'd say it's a bubble. But there is more and more, institutions, but also high net worth individuals, not just, I'm talking about India, I'm talking globally, who are saying, I believe in this technology, I believe in this, this currency, or will be some form of payment currency going forward.
Well, there you have it, guys. Well, Andrew Holland's outlook not only on the markets, Indian equities, but also cryptocurrency. But with that, it's a wrap on this edition of Thank God It's Friday. Andrew, once again, we'd like to thank you
very much
for joining us and taking us through your views. And we'll see you guys next week on another edition of Thank God It's Friday. Till then, it's goodbye.